Today, we're going to examine and unravel the mysteries of two crucial pillars of accounting: financial accounting and managerial accounting. Do I need to mention what you stand to lose by skipping this video? I hope not. For many large corporate firms, financial management is key. On one corner, we have financial accounting, the very meticulous recorder of a business' financial health, and in the other, managerial accounting, the weapon used for strategic decision-making by most managers. We're about to dissect these accounting pillars, reveal their strengths and differences, and also talk about why they are essential in the world of businesses. Stay tuned, because by the end of this video, you'll not only understand the distinction between these two accounting methods, but also be equipped with the knowledge of how to use them to your advantage. Let's get started. Is financial accounting relevant in an organization? Financial accounting is the backbone of any organization's financial management. It is a systematic processing of recording, summarizing, and reporting an organization's financial transaction and activities. The primary purpose of financial accounting is to report the company's financial information to external stakeholders. These stakeholders include investors, creditors, regulators, and the general public. Financial accounting relies on three key financial statements. And what are those three key financial statements? Balance sheet is the first one. This document provides a snapshot of a company's financial position at a specific point in time. It lists assets, what the company owns, liabilities, what it owes, and shareholders' equity, the residual interest in the assets. Income statement, also known as the profit and loss statement. This report details a company's revenue, expenses, net income or loss over a period, typically a fiscal quarter or year. Cash flow statement. This statement tracks the inflow and outflow of cash and cash equivalent. It's divided into three sections: operating activity, investing activity, and financing activity, giving stakeholders insight into how cash is managed. Let's talk about some of the principles and guidelines, that terms that you may need to know as you dive into the subject. First is GAAP, or IFRS. Financial accounting follows a set of principles and guidelines. In the United States, generally accepted accounting principle, or GAAP, provides the framework, while the International Financial Reporting Standard, or IFRS, are used globally. These standards ensure consistency, comparability, and reliability in financial reporting. So what do we mean by managerial accounting? Managerial accounting, often referred as management accounting, primarily helps the folks within the organization make smart decisions. Managerial accounting takes the numbers, juggles them, and transforms them into insights that managers can use to make decisions. Now, here's the interesting part: the flexibility and lack of regulatory standards in managerial accounting. Unlike financial accounting, which follows strict rules like a courtroom, managerial accounting is more like jazz. It improvises to meet the specific need of a company. This flexibility allows for creative problem solving tailored to unique situations. What are the key differences between financial and managerial accounting? Now that we have an idea what both type of accounting is all about, let's explore the key differences, shall we? First off, the audience. Financial accounting plays to the gallery. It's all about external stakeholders. Think shareholders, regulators, and the general public. They want to know financial health of a company. In contrast, managerial accounting is an intimate affair catering to the internal crowd, the management team, the people that sit on top of your company. It's like, you're sharing secrets with your closest friends. They also differ in their reporting frequencies. Financial accounting adheres to a strict schedule. It is periodic, usually quarterly or annually, ensuring consistency and comparability. Meanwhile, managerial accounting reports as needed, as many times as you can, maybe even 2 or 3 times a day if you need it that often. As mentioned earlier, regulatory standards is another area that sets them apart. Financial accounting, like we mentioned, follows very strict rules. There's no room for interpretation, it's all about compliance. Managerial accounting, on the other hand, is the jazz club of accounting. It's flexible, improvises to meet the unique need of each company. The focus sets them apart too. Financial accounting is all about history. It deals with past data. Managerial accounting, however, is slightly different. It looks into the future and helps businesses plan and make strategic decisions. It's forward-thinking. Sometimes managerial accounting is very much in line with what they call FP&A, which is financial planning and analysis. But before we proceed, please do me a favor and hit that like and subscribe button. This is so you do not miss out on future updates that can help your small business thrive. Cool? Done? Thanks so much. Let's see what's next in stock for us. So, is there a common ground for both types of accounting? The answer to that is yes. Both types of accounting are essential and have common grounds where they meet. Costs, for instance, are language that both accounting types speak frequently. Financial accounting tracks historical costs to report to external stakeholders, while managerial accounting forecasts costs to aid internal decision-making. Revenues are another area of convergence. Both types of accounting keeps a close watch on the money floating in. Financial accounting ensures accurate reporting to stakeholders and regulators, while managerial accounting evaluates the sources of revenue and help optimize them. It's like two detectives investigating the same case from very different angles. Financial data is another area where they are similar. Both financial and managerial accounting relies on the same financial data for different purposes. Lastly, there's one more similarity between financial and managerial accounting. Ever wonder why financial accountants and managerial accountants are the life of the party? Well, it's simple. The financial accountant can balance any awkward moments, and the managerial accounting knows how to manage a fun time.
Crickets, crickets, crickets.
Crickets? Yeah, I know. That's the best joke I got. So let's jump into some case studies. Now, I know you must be very curious as how these accounting methods could work in real life. No cause for alarm. Right now, we'll dive into some real-world case studies that showcase the practical application of financial and managerial accounting in various scenarios. Our first case study is a retail giant's inventory management. Imagine a retail giant managing its vast inventory. Financial accounting comes into play as it records the cost of inventory and tracks its value over time for financial statements. But here's where managerial accounting steps in. To optimize inventory turnover, the management team relies on managerial accounting to analyze sales trends, identify slow-moving items, and make informed decisions about restocking, pricing, and markdowns. Case study 2 examines manufacturing efficiencies. In the manufacturing sector, a company aims to reduce production costs. Financial accounting helps by tracking the historical costs of raw materials, labor, and overhead. But to truly enhance efficiency, managerial accounting is the way to go. Identifies areas for cost reduction through activity-based costing, process improvements, and lean manufacturing techniques. In case study number 3, we beam a light on healthcare budgeting. A hospital needs to create a budget to ensure it can provide quality care while managing costs. Financial accounting records the historical financial data and is essential for regulatory compliance. However, managerial accounting steps up to the plate by analyzing patient data, departmental performance, and resource allocation. This allows the hospital to make good decisions about staffing levels, equipment purchases, and patient service, all while staying within budget constraints. I hope these case studies have helped illustrate how financial and managerial accounting works hand to hand, each playing a distinct but vital role. They are really the backbone of sound financial management. Pros and cons. Before we wrap things up, let's weigh the pros and cons of both financial and managerial accounting to get a balanced view of their strengths and limitations. Financial accounting advantages. Transparency. Financial accounting provides a transparent and standardized view of companies' financial health, fostering trust among external stakeholders like investors and creditors. Regulatory compliance. It ensures compliance with accounting standards and legal requirements, reducing the risk of financial misconduct and fraud. Historical perspective. It offers a historical perspective, allowing for accurate financial reporting and comparison over time. Investor confidence. Accurate financial statement attracts investors and helps companies access capital at favorable terms. Here are the limitations of financial accounting. External focus. Financial accounting primarily serves external stakeholders, so it may not provide the detailed insights needed for internal decision making. Rigidity. It follows strict rules and standards, limiting flexibility and adaptation to unique business situations. Limited future orientation. Financial accounting is backward-looking, offering little insight into future trends or forecasting. Let's turn the table now to managerial accounting. Advantages. Internal decision support. Managerial accounting aids internal decision-making by providing tailored information that guides strategy, resource allocation, and cost control. Flexibility. It is highly adaptable, allowing for customized reporting and analysis based on the specific need of a company. Future-oriented. Managerial accounting focuses on the future, enabling proactive planning and forecasting. Operational efficiency. It identifies cost-saving opportunities, improve efficiency, and help businesses stay competitive. Here are the limitations. Subjectivity. Managerial accounting involves subjective estimates and assumptions, which can lead to potential bias in decision-making. Lack of standardization. Due to its flexibility, there are no strict standards, making it challenging to compare practices across organizations. Resource intensive. Gathering and analyzing data for managerial accounting can be pretty time-consuming and costly. It is safe to say in conclusion that financial accounting excels in providing transparency and compliance with external standards, but may lack the flexibility and future-oriented insights required for internal decision-making. Managerial accounting, on the other hand, empowers businesses to make informed decisions, optimize operations, but relies on subjective data and lacks standardization. In practice, These accounting types complement each other, with financial accounting satisfying external stakeholders and managerial accounting supporting internal management, creating a comprehensive approach to financial management in the business world. And that's it for today. Thank you for sticking around to the end of this video. If you enjoyed or learned from it, then you should hit that like and subscribe button. You won't regret it, I promise, because there's a lot more great info coming up. If there's anything we can add, please leave a comment below, and we'd love to hear from you, and even possibly make a video of your next comment that you leave below. Hey, we'll see you next time. But hey, if you're ready to take control of your finances, look no further. Book a personalized call with me or any of our expert partners to elevate your tax saving and bookkeeping game. Don't let financial stress weight you down. Let us guide you towards financial freedom. Schedule your consultation now using the link below. Your path to financial success starts now. Alrighty, that's it for me. Alan out.